One of the companies that is poised to take advantage of one of the fastest growing industries over the next decade is ASML, currently trading at $721.04 per share, but over the past year they're down about 5.46%, and if we look at them year to date, 4.74%, and in the last 6 months, down 28.04%. Now, if you've never heard of ASML, this is a company headquarters in the Netherlands. And the company is the leading provider of advanced semiconductor equipment systems. So for example, if we look at some other companies currently in this industry, obviously you're going to see some names you've probably heard a lot over the past year. We have Nvidia, Broadcom, Taiwan Semiconductor, and then the fourth largest player in this industry is going to be ASML. And we can see ASML is currently a $286 billion company, while these other three companies are all above $1 trillion, obviously with Nvidia being one of the largest in the world at about $3.4 trillion. Now, ASML has a lot of investors excited, especially for the next decade, because there's so much growth expected. They're nearly a monopoly, and they have a massive moat. And this is basically the result of its incredibly advanced EUV lithography technology. And this technology is one of the most critical components in the manufacturing of high-end chip technology. And a growing number of industries like AI, cloud computing, and automotive are experiencing a huge spike in demand for these high-end semiconductor technologies, which can only be manufactured by ASML's machines. When it comes to ASML, we have to understand that their technology is years ahead of any of their competitors. And their competitive advantage is actually only growing. For example, if we jump over to my stock screener, let's look at the quarterly data. We'll come up here and plug in ASML and look at research and development expenses. Thanks to the ticker data add-on in Google Sheets, all this data will automatically load in, and what we can see is the company isn't slowing down R&D. In fact, they're increasing it. And so ASML is poised to continue to take advantage of the massive growth in their sector. For example, if we look at artificial intelligence expected market size from 2023 to 2033, at the end of 2023, it was sitting at $1.33 billion, and by 2033, it's expected to be coming in at $8.54 billion. And we can see despite ASML's massive lead compared to the competitors, the company is continuing to innovate and produce even more advanced systems. And these are likely systems that companies like Amazon, Google, and Microsoft will continue to take advantage of for their AI training and cloud infrastructure. And if we look at one of the very first slides in their investors presentation from last month, we can see a statement here. We expect that our ability to scale EUV technology into the next decade and extend our versatile holistic lithography portfolio could place ASML at the heart of the AI opportunity. This would continue to create significant growth in revenue and profitability in this decade. For perspective, earlier this year, the company was trading as high as $1,110 per share, so we're talking about a significant sell-off in the stock. Well, it all started after their Q3 earnings report, and this report could only be described in one way, and that was chaotic. To start off, the company was slated to publish its third quarter results on a Wednesday one week, but the results were mistakenly pre-published on the ASML's investor relations website a day early. Now, if we jump back over to Seeking Alpha and actually look at the results of this earnings report, they actually beat on top and bottom lines. We can see them beat earnings right here. But the big problem is if we look here, ASML's third quarter bookings fell 53% quarter over quarter to about $2.63 billion compared to Bloomberg consensus of $5.39 billion. So that's a huge miss when it comes to bookings. And then if we scroll down, we can see there was a change in outlook. For the year 2025, ASML lowered the net sales forecast of $30 billion to $35 billion, when previously the company was expecting about $30 billion all the way up to $40 billion with a midpoint estimate of about $36 billion. So they reduced 2025 guidance. Now, there's plenty more to discuss, but let's start to dig into some of the financials for the company. Now, one of the other major subjects of the earnings call is management is now stating they expect China revenue to decrease to about 20% of total revenue, which was in line with current bookings, but it's down from 40% in 2023. But to be fair, this is trending back towards the historical China percentage and in line with its share of the backlog. Now, there's plenty more we can touch on, but I do want to start to dig into the financials. And to start off, if we jump over to the dividend breakdown tab and plug in ASML, this data will load in. And like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. But what we can see is ASML doesn't just pay out a dividend, it actually pays out a growing dividend. And while the yield is low, the dividend growth has been astronomical. 10-year dividend CAGR of about 23.2% and a 5-year of about 13.6%. And they actually talk about their capital allocation framework. in their most recent earnings presentation. And basically what they state, if we come down here, they're going to continue to invest in our business, which obviously should be their main priority, but they also expect to return significant amounts of cash to our shareholders through growing dividends and share buybacks. Again, they tell us that dividend will grow over time and it should be paid on a quarterly basis. Now, if you're an American investor, you're used to quarterly dividend payments, but a lot of the times European companies might pay out on a semi-annual basis, so this is worth noting. Now, they also talk about returning excess cash to shareholders through share buybacks, so let's jump back over to my stock screener and look at share buybacks. Come up here and plug in ASML. What we can see is if we come down here, yes, the company has been buying back shares, but it hasn't been a major priority for the company up to this point. Now, while we're over here, look at how fast the earnings per share for the company has grown over the past decade. In 2013, it's sitting at $2.78, and at the end of 2023, earnings per share was nearly $20. And to put this into perspective, if we jump back over to the earnings presentation, we can see ASML's earnings per share has grown at a compounded annual growth rate of 22% since 2014, driven by revenue growth, improved margins, and share buybacks. And as a result, if we scroll down, we can see ASML has way outperformed the market since 2010 when looking at total shareholder return. And if we look at the semiconductor index, it is up about 22%. So obviously ASML has ridden the coattails of the semiconductor index, but it has slightly beat it as well. After this huge sell-off over the past 6 months, down around 28%, does this create an opportunity to buy this market leader who is poised for massive growth and is planning on rewarding shareholders with buybacks and dividends? Well, to start off, let's look at some earnings projections for this company. If we scroll down, we can see, like we already know, after this most recent earnings report, earnings are going to be down just a little bit by the end of this fiscal year. But if we look at projected growth after that, we're talking above 20% for the next 3 years and double-digit growth moving forward. And those numbers really shouldn't come as a surprise to anyone who understands just how far ahead they are with their technology. So when we talk about the valuation for this company, when we talk about hyper-growth stocks, it can be really difficult to value them for multiple reasons. Projections become very difficult. So one of the ways we can value them is by using what's known as a reverse discounted cash flow analysis model. And what this allows us to do is to see how much free cash flow growth the market is pricing into this stock. So what I've done, because this is kind of a unique situation, free cash flow has been a little bit lower over the past couple of years, and we know it's going to be a little bit lower in 2024, but what I did for 2025 was place it in between 2021 and 2022 free cash flow. We're going to assume that free cash flow is going to recover. And so if we come up here and plug in 5% free cash flow growth for the next decade, we come to a reverse DCF price per share of about $348, which is still pretty far off from the current trading price. If we bump it up to 10%, we're still not to that current trading price, and if we bump it up to around 18%, we start to get close, and at 19%, we get very close to the current share price for the company. So what this DCF is telling us is the market is pricing in around 19% free cash flow growth for this company once they recover back to their 2021-2022 free cash flow levels. Now the question we have to ask ourselves is, do we think that's attainable? Because if we do, then it could be a good valuation, and if we don't, then it's probably something we want to stay away from. Now this growth in free cash flow isn't only going to come from major growth in revenue, but their margins are going to increase as well. For example, if we jump over to the profitability tab, we've already plugged in ASML. What we can see is margins have already started to expand. Starting in 2013, the gross profit ratio was 39.77. Look where it was last year, sitting at 51.29. And what this company is telling us is they expect it to continue to increase moving forward over the next few years. So when you combine expanding margins with a revenue CAGR of above 20%, it bodes very well for this company. And keep in mind, if we actually look at the balance sheet, we'll come up here and plug in ASML. We can see ASML is in a very, very healthy position. Look at total assets sitting at $41.7 billion and total debt only about $4.7 billion. So the debt to assets ratio is just 0.11. The current ratio looks fine as well at 1.55. But here's one of the other major problems with looking at this reverse discounted cash flow. The free cash flows for this company are going to be very choppy over the next decade. I do expect them to grow at a very high rate, but let me show you what I mean. If we jump over to my free cash flow analysis sheet, come up here and plug in ASML. If we come over here, here's what I want to show you. Look at free cash flow margin. Now, what is free cash flow margin? Well, it's essentially telling us out of the revenue the company produces, how much is becoming free cash flow. So for example, 2023, free cash flow margin was 11.78%. So for every $100 the company generated in revenue, $11.78 became free cash flow. But look at how much the free cash flow margins for this company have fluctuated over the past decade. At one point, it was as high as 53.44%, and then 2023 was actually the lowest it's been at about 11.78%. Now, we should see it moving higher in the future as margins continue to expand, but I do still think there will be quite some fluctuation with this number. So ASML is undoubtedly one of the more interesting opportunities moving forward. I think if you're someone who can't handle volatility very well, this is definitely something you want to stay away from. But if you're someone looking to take advantage of the AI race, of the semiconductor growth, and you also want to be rewarded as a shareholder with share buybacks and growing dividends, then ASML really presents a very interesting opportunity. This is definitely one that I'm going to continue to have on my personal watch list. But go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.